Hi, good evening everyone. Today, we are pleased to present our case study on Farm Fresh Berhad. This presentation is prepared by Group 3 as part of our Bachelor of Corporate Administration program under the Faculty of Administrative Science and Policy Studies. Farm Fresh Berhad is a well-known Malaysian company in the dairy industry recognized for its integrated farm-to-table business model. Through this case study, we will analyze the company's financial performance focusing on key financial ratio and overall financial health. Let us begin our presentation. This is our team members. The first one, which is Nazra binti Yusaini, 2024 351543. The next one, which is Nazatul Fakira Aina binti Razali, 2024 366621. The next one, Nur Fatiha binti Hamdan, 2024 187 651. And me, Nur Alia Sahira binti Cherani, 2024 773 701.
Good morning everyone. Today I'll be presenting about Farm Fresh Berhad, a leading Malaysian dairy company. So Farm Fresh was founded with the mission to provide fresh, natural dairy and product directly from farms to consumer. It started as a small dairy farm in Johor led by Lloyd Tuan E, focusing on milk-free from preservative and artificial additive. So the company follows a grass to glass model, managing everything from farming, milking, processing to retail. This ensures that quality and traceability, helping build a strong brand and consumers' trust in Malaysia. So over the years, Farm Fresh had expand operations, including investment in Australia to boost milk supply and diversify its products. So today the company offers over 200 SKUs, including flavored milk, plain-based milk, yogurt, ice cream, growing up milk, and reflecting its growth from a local farm to a regional dairy brand. So what are the core business activities? Farm Fresh covers the full dairy value chain. Firstly, farming. Large herds raised in pasture-friendly environments for high-quality milk. Next is processing, pasteurizations, packaging, and production of various dairy products. And next is product development and sales, fresh milk, flavored milk, yogurt, ice cream, butter, and so on. And then distribution channels are extensive. Supermarkets, convenience stores, HoReCa outlets, home dealers, and also agents. The company also exports to countries like Singapore, Brunei, Philippines, and it expanding into Cambodia. This strategy ensures wide market, enriched and strengthened revenue stream. And then, so finally, let's consider the industry Farm Fresh operates in. Farm Fresh is a part of a dairy products industry within the food and beverage sector. The industry involves animal husbandry, milk supply, processing, packaging, distributions, and retail. A key challenge is the perishable nature of dairy products, requiring strong cold chain, logistics, and strict food safety standards. The Malaysian market is highly competitive, with players like Dash Lady, FNN, alongside local and imported brands. Consumer trends are shifting towards health-conscious, convenience, and plant-based options such as ready-to-drink milk and oat or almond milk. So regional export opportunities in Asians are driving companies to innovative and adapt to changing consumer preference and regulatory requirements. So next, let's look at the company factors influencing Farm Fresh financial performance. Consumer purchasing power and economic growth directly impact demand for dairy products, especially premium and value-added products. When household income rise, consumers are more likely to buy higher quality and diversified products. This also rising input costs, including feed, energy, transportations, and packaging, can compress profit margins if not managed effectively. Foreign exchange fluctuations also affect the cost of imported inputs and revenue from exports, important as Farm Fresh expands in Southeast Asia. So, now we're moving to industry-specific factors. In the financial year ending March 31, 2025, Farm Fresh reported RM 981.18 million, and the net profit is RM 106.4 million. This represents a strong year-on-year growth in both sales and profitability. Growth was supported by expanding product categories like ice cream, chocolate milk, milk powder, cultured meat, and other high-margin products. Diversified distribution channels like HoReCa, mini markets, and regional market help reduce reliance on traditional fresh milks. So the capacity expansions and regional market strategy show how competition and innovation in the industry drive Farm Fresh financial performance. Next, we will discuss about the Farm Fresh liquidity ratios, which measures the company's ability to meet short-term obligations using its current assets. So, liquidity ratios indicates how easily current assets can be converted to cash to pay liabilities due within 1 year. They help investors, creditors, and management assess short-term financial health and operational stability. So, the first is the current ratio, which comprises current assets to current liabilities. For the formula, is current ratio equal to current assets plus current liabilities. So, in 2023, Farm Fresh have 2.55 ringgit in current assets for every 1 ringgit of their liability. This shows that they have a strong liquidity. Meanwhile, in 2024, Farm Fresh have RM 2.19 in current asset for every RM 1 ringgit of their liability. That means they are still healthy. Six is a quick ratio, which exclude inventory from current assets. For the formula, is quick ratio equal to current assets minus inventory divided by the current liabilities. So for 2023, 2.26 ringgit in liquid assets for every and 1 ringgit of liabilities, showing that the company is very strong liquidity without relying on inventory. For 2024, 2.06 in liquid assets for every 1 ringgit of liability, showing that the company is still healthy. So slight decline reflects faster growth in liabilities or lower inventory, but the company consistently maintains strong short-term stability. Finally, cash ratio measures immediate liquidity. For the formula, is cash ratio equal to cash divided by current liabilities. For 2023, 0.076 in cash for every RM1 ringgit of liabilities, showing that it is very low and cannot cover obligation with cash alone. And 2024, showing that 0.125 in cash per RM 1 ringgit of liability, showing that it's a slight improvement on that. So for the analysis, ratio remains low but typical for businesses that rely on receivables and other current assets. Slight improvement shows better cash management. So for the significance, liquidity ratios are key because they indicate the company's ability to meet its short-term obligation using current assets. This is important for daily operations and ensure that the company can cover liabilities due within a year. Strong liquidity also reassures creditors and investors when these ratios are high. It signals a lower risk of default, making the company a safer choice for investment or lending. Additionally, these ratios reflect the efficiency of working capital management. By comparing current assets and liabilities, management can evaluate how effectively resources are being used to maintain smooth operations. So for the strengths, the current ratio remains strong at 2.55 in 2023 at 2.19 in 2024, well above the generally accepted benchmark of 1.0. This indicates that the company consistently has more than enough current assets to cover its liabilities, reflecting the healthy short-term financial positions. And then the quick ratio, which excludes inventory, is also strong at 2.26 in 2023 and 2.06 in 2024. This shows that even without selling inventory, the company has sufficient liquid assets to meet its obligations. It also highlights effective cash and receivable management. And then, lastly is the weaknesses. Despite this strength, there is a slight declining trend in both current and quick ratios. This could indicate that the current liabilities are growing faster than current assets, which may pose future liquidity risk if the trend continues. The cash ratio remains low, meaning that the company cannot fully rely on cash alone to cover short-term obligations. This emphasizes the need for careful cash flows and planning. The company also depends heavily in non-cash current assets like receivables. While this is typical in many businesses, it creates some risk in collections are delayed or if there is an economic slowdown.
Now I will explain the profitability ratios analysis of Farm Fresh Berhad for the financial year 2023 and 2024. Profitability ratios measures a company's ability to generate profit relative to sales, assets, and shareholder equity. These ratios helps evaluate financial performance, operational efficiency, and value creation for shareholders. The first one is gross profit margin. Gross profit margin measures the percentage of revenue remaining after deducting the cost of goods sold. In 2023, Farm Fresh recorded a GPM of 20.5%, meaning the company retained 21 cents from every 1 ringgit of sales after covering direct production costs. In 2024, the GPM increased to 23.6%. The increase shows that Farm Fresh became more efficient in controlling production costs or improved its pricing strategy. This improvement indicates stronger operational efficiency and higher profitability at the gross level. The second one is net profit margin. Net profit margin shows the percentage of revenue that remains as net profit after all expenses, including operating and administrative costs. In 2023, the net profit margin was 21.9%, meaning Farm Fresh earned 22% net profit for every 1 ringgit of sales. In 2024, the margin improved significantly to 30.4%. The rise indicates strong improvement in cost control, operational efficiency, and profitability. This suggests that FarmFresh managed expenses effectively while increasing revenue, leading to a stronger financial performance in 2024. Next, we measure the returns on assets. Return on assets measures how effectively a company uses its total assets to generate profit. In 2023, FarmFresh recorded an ROA of 7.95%, meaning it generates 8% profit from every RM1 invested in assets. In 2024, ROA increased to 9.35%. The increase shows that FarmFresh improved its efficiency in using assets to produce earnings. This reflects better operational performance and more effective asset utilizations in 2024. Last but not least is return on equity. Return on equity evaluates how efficiently a company uses shareholder funds to generate profit. In 2023, the ROE was 13.06%, meaning shareholders earned 13 cents profit from every RM1 invested. In 2024, ROE increased to 17.19%. The increase indicates that FarmFresh delivered higher returns to shareholders in 2024. This improvement reflects stronger profitability, better capital management, and enhanced shareholder value. Based on the profitability ratios analysis and the chart shows, FarmFresh Berhad demonstrates strong financial performance and significant improvement from 2023 to 2024. In terms of strength, the increase in gross profit margin and net profit margin indicates strong cost control, effective pricing strategies, and enhanced operating efficiency. This means that the company was able to return more profit from each ringgit of sales. Additionally, the higher return on assets reflect better utilizations of company assets to generate revenue and profit, showing improved operational effectiveness. The increase in return on equity further indicates that FarmFresh delivered better returns to shareholders, highlighting stronger value creations and efficiency use of equity capital. Overall, this improvement demonstrates that FarmFresh achieved solid profitability growth and financial stability in 2024 compared to 2023. In terms of significance, the overall improvement in profitability ratios reflect stronger operational efficiency, better cost management, and enhanced financial sustainability. Improved asset utilizations allow FarmFresh to generate higher profit without significantly increasing costs, which strengthen both ROA and net income. Furthermore, stronger profitability positions the company in a more competitive, stable, and sustainable market positions, supporting long-term business growth and investor confidence.
So the next one, which is efficiency ratio. The efficiency ratio, also called as the operation ratio, measures the manner in which a business successfully increases the benefits by using its asset and also the liabilities. The primary productivity measures include revenue and also the inventory sales day. So the first one, which is inventory turnover. The inventory turnover shows the formula of COGS divided with average inventory. For 2023, we got 2.51 times. The inventory ratio was 2.51 times, indicate that the FarmFresh Berhad took a longer time to sell and also replace the inventory. So this shows a slower inventory management and possible the inefficiency in inventory management. For 2024, we got 3.75 times. The inventory turnover improved significantly to 3.75 times, showing that the inventory was sold and replenished more frequently. So the better the inventory control, the higher the turnover will reflect. So the next one, which is total asset turnover. The total asset turnover, the formula for the total asset turnover, net sales divided with average total asset. And for 2023, we got 0.36 times. The total asset turnover ratio stood at 0.36 times, indicate that the FarmFresh generate 36 cents of revenue for every RM1 of total assets, reflecting the low revenue compared to its total asset. For 2024, we got 0.42 times. A total asset turnover of 0.42 times indicates that the company generates 42 cents of revenue for every RM1 of total assets, reflecting the improved efficiency in using its asset base to generate revenue. So the last one, which is receivable turnover. Receivable turnover's formulas, which is net sale divided with average account receivable. For 2023, we got 6.32 times, which is indicate that the FarmFresh collected its receivable approximately 6.32 times during the year, reflecting the slower collections efficiency and also the longer credit periods. And the last one, 2024, we got 6.76 times. A receivable turnover of 6.76 times indicate that the company collected its receivable more frequently during the year. reflecting the improved credit control and also the faster conversion of receivable into cash. So based on the efficiency ratio, Farm Fresh Berhad shows several strengths. Inventory turnover improved from 2.51 times in 2023 to 3.7 times in 2024, indicates the better inventory management. Fixed asset turnover also increased from 2.41 times to 2.85 times, showing more efficient use of fixed asset. In addition, the receivable turnover rose from 6.32 times to 6.76 times, reflecting the improved credit control and faster cash collection. However, there are some weaknesses. Total asset turnover remains relatively low despite the increase from 0.36 times to 0.42 times, suggesting that the company is still not fully utilizing its total assets. Inventory movement was also slower in 2023, indicating earlier inefficiencies, and reliance on credit sales may still affect the liquidity if not managed carefully. Overall, the several significant insights can be drawn from the analysis. The consistent improvement across all efficiency ratio in 2024 indicates the stronger operational efficiency and better management performance compared to 2023. The improvement in fixed asset and total asset turnover suggests that the investment in assets have begun to contribute positively to sales growth. In conclusion, Farm Fresh Berhad has shown clear progress in managing its assets and operation more efficiently, although this remains room for further improvement, particularly in maximizing the total asset utilization.
Then we have leverage ratio. Leverage ratio are a category of a financial metrics used to assess the degree to which a company relies on borrowed funds, which is debt, to finance its operations and growth, relative to its equity or asset. They measure the long-term solvency and financial risk of business by evaluating its capital structure and its ability to meet long-term financial obligation. In leverage ratio, it includes debt ratio, debt to equity ratio, and time interest earned ratio. Firstly, to find debt ratio, the formula is total debt over total assets. For Farm Fresh in 2023, 223,126,000 ringgit over 7,088 million 824,000. Then we got 28.3%. For every RM1 of total assets, Farm Fresh Berhad finances 28 cents with debt from creditors. Next, in 2024, 308,926,000 ringgit over 931,505,000 ringgit. Then we got 33.2%. For every RM1 ringgit of total asset, Farm Fresh Berhad finances 33 cents with debt from the creditors. Furthermore, to find debt to equity ratio, the formula is total debt over total equity. For Farm Fresh in 2023, 223,126,000 ringgit over 479,666,000 ringgit. Then we got 46.5%. For every RM1 of total equity, Farm Fresh uses 47 cents of debt to finance its assets. Next, in 2024, 308,926,000 ringgit over 506,553,000 ringgit. Then we got 61%. For every RM1 of total equity, Farm Fresh uses 61 cents of debt to finance its assets. Finally, to find time interest earned ratio, the formula is earning before tax over interest expense. For Farm Fresh in 2023, 231,163,000 ringgit over 8,843,000 ringgit. Then we got 2.62 times. Farm Fresh Berhad's operating profit cover its interest expenses 2.62 times. Next, in 2024, 24,463,000 ringgit over 11,830,000 ringgit. Then we got 2.07 times. Farm Fresh Berhad's operating profit cover its interest expenses 2.07. Starting with the strengths, Farm Fresh entered 2023 with a conservative and stable leverage structure. The debt ratio of 28.3% means only 28 cents of every RM1 in assets was debt financed. The debt to equity ratio of 46.5% indicated a healthy balance, which is using more equity than debt. And the last one is time interest earned ratio of 2.62 times, show a strong ability to cover interest expenses from operating profit. In short, Farm Fresh began from a position of low financial risk and good creditor safety. However, by 2024, we see some concerning shift, which is in debt dependency increase. Both the debt ratio and debt to equity ratio rose significantly to 2023 to 2024. Next, interest coverage weakened. The TIE ratio dropped, meaning earnings are now covering interest expenses less comfortably. Last one is this point to higher financial risk and potential strain on cash flow if earnings dip. FarmFresh is taking on more debt, which could amplify risk in a downturn. So, why should we care about this ratio? For the first one is for risk assessment. They measure financial stability and long-term solvency. Next is for stakeholders. Creditors use them to gauge repayment risk, which is the investors look at capital efficiency. Last one is for management. This ratio guide financing decision, which is balancing growth with prudence. In FarmFresh case, the rising leverage suggests a strategic move toward debt-funded expansion. So, what does this mean for FarmFresh? The
That's
company
all
is using
from
debt
us.
to
Thank
fuel
you
growth,
for
which can be
watching.
good for expansion but risky if not managed well. The declining interest coverage is a warning sign that requires close monitoring. To conclude, FarmFresh started 2023 with a strong, low-risk leverage position. By 2024, it shifted toward higher debt financing, which supports growth but increases in financial vulnerability. Going forward, careful debt management will be key to sustaining healthy expansion. Lastly is earnings per share trend analysis. Okay, what is earning per share? It is a financial evaluation method that tracks and examines the changes in company's EPS over a defined period, such as quarterly, annually, or across multiple years. It is to assess its profitability, performance, growth trajectory, and shareholder value creation. Okay, to find EPS, the formula is net available to common stock over number of ordinary shares issued. For FarmFresh in 2023, 50,079,000 ringgit over 1,861,912,000 ringgit, then we got RM 2.69. For every one share, FarmFresh Berhad earned RM 2.69 per share. Next, in 2024, 63,530,000 ringgit over 1,899,695,000 ringgit, then we got RM 3.40 ringgit. For every one share, FarmFresh Berhad earned RM 3.40 per share. The strength of FarmFresh Berhad is first, consistent growth in EPS. EPS increased from RM 2.69 in 2023 to RM 3.40 in 2024, demonstrating a clear upward trend in profitability on a per share basis. This indicates effective earnings growth and value creation for shareholders. Second one is driven by strong net income growth. The rise in EPS was supported by a significant increase in net income available to common shareholders, which grew from RM 50,079,000 ringgit to RM 63,530,000. This reflects the company's operational success and improved financial performance. Then, last one is efficient share management. The increase in EPS occurred despite a slight rise in the number of ordinary shares issued, showing that earnings growth outpaced equity dilution, which is favorable for existing shareholders. Then we have finances in FarmFresh Berhad. For the first one is moderate EPS growth rate. Although EPS grew, the absolute increase RM 71 cent may be considered moderate in the context of aggressive growth expectation or compared to industry benchmark, potentially indicating room for more aggressive profitability strategies. Next, dependence on continued profitability. The positive EPS trend is contingent on sustained net income growth. Any future decline in profitability due to rising costs, market competition, or economic downturns could quickly reverse the EPS trend. Last one is limited context without industry comparison. The report does not benchmark FarmFresh EPS against the competitors or industry averages, making it difficult to assess whether the EPS growth is truly strong relative to peers. So why EPS is important to FarmFresh Berhad? First one is indicator of shareholder value. EPS is a direct measure of profitability attributable to each common share, making it a key metric for investor assessing returns on equity investment. Second is signal of financial health and growth trajectory. A rising EPS trend signals that the company is generating more profit with its resources, that can reflecting operational efficiency, successful expansions, and effective management. Last one is supports investment and strategic decision. EPS trends influence investor confidence, stock evaluation, and access to capital market. A consistent upward trend can enhance the company's ability to raise funds, attract investors, and support future growth initiatives such as acquisition or R&D. Okay, now to conclude, FarmFresh Berhad's EPS trend analysis reveals strength in growing profitability and shareholder value, though it also highlights the need for sustained performance and competitive benchmarking. The trend is significant as it reflects the company's ability to deliver returns to investors and signals underlying operational and financial health.
So this slide presents the financial ratio analysis of Farm Fresh Berhad for the financial year 2023 and 2024. So overall, the result indicates the improvement in both of the company's operational and financial performance. In terms of the liquidity, the current ratio and quick ratio show a slight decline in 2024. However, both ratio remains above industry benchmark, indicate that the Farm Fresh continues to maintain a strong ability to meet its short-term obligations. Although the company still relies more on receivable and liquid asset rather than cash, there was an improvement in cash management as reflected by the increase in the cash ratio in 2024, despite its remaining relatively low overall. Looking at profitability, all key ratios including the gross profit margin, net profit margin, and return on assets, also the return on equity, improved in 2024. This suggests better cost control, the improved pricing strategies, and also more efficient use of assets and shareholders' equity. Efficiency ratio also improved during 2024, indicates the better inventory management, faster collections, and also the enhanced operational efficiency. However, the leverage analysis shows an increase in financial risk. Both the debt ratio and also the debt to equity ratio increased, while the time interest earn ratio declined, suggesting higher reliance on debt financing and increase the pressure from borrowing costs. Despite this, the increase in profit before tax and earnings per share reflect positive growth in shareholder value. In conclusion, while Farm Fresh Berhad demonstrates the strong financial performance, effective debt management is essential to sustain the long-term financial health. So the next one, which is the importance of the financial ratio analysis. Financial ratio are calculations that derive from the company's financial statement and also to use to evaluate its performance and overall the financial health. Financial ratio analysis involves examining the key ratios that are related to the liquidity, profitability, leverage, and also the efficiency, which help to analyze and stakeholders to identify the company's strength and also the weakness, monitor the performance trends, and compare the result with industry benchmark. One important aspect of the ratio analysis is liquidity, as it reflects a firm's ability to meet the short-term financial obligation using its most liquid assets, such as through the current ratio and quick ratio. Maintaining the adequate liquidity is essential to ensure the smooth business operations and to manage the unexpected financial challenge. In addition, the financial ratio analysis is useful not only for evaluating the current and past performance, but also for future planning and forecasting, as historical ratios help firms predict the trends, set realistic goals, and make the informed decision regarding the budgeting and also the investment. Finally, the ratio analysis supports the benchmarking by allowing the firms to compare their performance with competitors within the same industry, helping them identify areas for improvement, enhance the profitability, and also remain competitive in the long term. In conclusion, Farm Fresh Berhad's financial ratio analysis for year 2023 and 2024 shows the company's performance and also the financial position in the year analyzed. It is clear from the analysis that the company showed excellent liquidity in 2024, and it is improved its profitability, and it operated with enhanced operational efficiencies through the good cost management, better asset use, and increased the operational control. So the trend identified are positive for Farm Fresh Berhad and show that the company operates efficiently and will be able to produce the sustainable return. The analysis demonstrates that there are increased level of leverage. This indicates that the Farm Fresh Berhad is taking on more debt.